Okay, let's dive in. Welcome to Talk Tickers, where we get you straight to the core insights from earnings calls. Today, we're unpacking the McDonald's Q3 FY25 earnings call. This happened back on November 5th, 2025, just before the market opened. And looking at the market reaction, it was pretty interesting. Management gave somewhat cautious guidance. They made it clear they're spending quite a bit on investments, but the stock actually jumped pre-market. So that positive reaction, well, it tells you investors think McDonald's is putting money in the right places for the long haul for market share.
Exactly. And that's our mission for this deep dive, right? We need to figure out why the market liked a quarter that had, well, heavy investment and actually a slight miss on the bottom line. We've got to get past just the headline numbers and really look at three things for you. First, this consumer split in the U.S. How bad is it and why is it such a big theme? Second, McDonald's big value pushed the extra value meals. Is that really working long-term, or is it just, a costly short-term fix? And third, what about their international business? What's giving them the cushion to make these big investments back home?
Okay, good plan. Let's start with those headline numbers. So revenue came in at $7.08 billion. That's up 3% year over year, pretty much in line with what people expected, around $7.09 billion consensus. But the real story, like usual, was the top line. Global comparable sales grew 3.6%. And importantly, every single segment chipped in. The U.S. was solid, plus 2.4%, but yeah, the international part showed some real strength.
Yeah, that sales growth is definitely solid, particularly with all the economic pressures out there. But we do need to talk about the profit side, the bottom line, because that's where things got a little noisy. Adjusted earnings per share, it landed at $3.22. That missed the consensus estimate of about $3.23. So a miss by around, 11 cents?
Right. So if the sales were pretty strong, why the miss on profit? What happened there?
Well, management was pretty upfront about it, which actually tells us a lot about their strategy. It wasn't really an operational failure per se. It was more the cost of, fixing a longer-term issue and making some strategic changes. Two main things. First, they took a $39 million pre-tax charge for restructuring. They call it accelerating the organization.
Okay, accelerating the organization. Sounds a bit like corporate speak. What does that actually mean for the business?
Yeah, it basically means they're reorganizing things to cut down on corporate overhead. They want to focus their money and their people on the areas with the most growth potential. So think digital, that new beverage platform they're testing, and those strong international markets. They're trimming the fat, basically. The second thing was just a higher effective income tax rate for the quarter. Came in at 22.8%, a bit higher than expected. So if you kind of mentally adjust for those two items, the actual underlying operations look pretty healthy. And what's really fascinating, I think, is the strength of their business model overall. Get this. For the first time ever, total restaurant margin dollars went over $4 billion in one quarter. That's not just a big number. It fundamentally shows that as their franchisees sell more, McDonald's itself, acting as the landlord and franchisor, makes more margin dollars faster than its own costs go up. That operating leverage is key. It protects them way better than, say, a competitor who owns most of their restaurants.
That insulation makes sense. And it's really crucial because management spent a lot of time talking about their biggest challenge, that major split between consumers in the U.S. They pointed out that traffic from lower-income customers in QSRs, quick service restaurants, has been falling for almost 2 years now. And in Q3, it dropped nearly double digits. That's a huge drop.
It really is. And we need to understand why. It's not just inflation making things expensive. It's about elasticity, how people react. Management said this lower income group, they're really squeezed by basics like groceries going up. So fast food becomes like a real treat, a luxury. They're trading down, maybe packing a lunch from home instead of hitting the drive-thru. McDonald's has kind of lost their regular visits at frequency.
But on the flip side, the higher income QSR customer, they kept coming. Their traffic growth is also strong, up nearly double digits too.
Yeah, that contrast is stark. And it makes McDonald's main strategy, this whole value is working thing, absolutely essential. It's aimed squarely at winning back those lost visits from the lower income group. They relaunched the extra value meals, the EVMs, back in September. And this was very deliberate. They're trying to rebuild trust. Because let's face it, years of menu prices slowly creeping up had kind of damaged that core value image McDonald's used to have.
And this wasn't just a small change, was it? They standardized the discounts, minimum 15% off across the board. That's a bigger discount than the old average, which was around 11%.
Exactly. You're putting serious corporate weight behind specific deals, like that $5 sausage McMuffin with egg meal or the $8 Big Mac meal. They advertise those nationally. And here's the kicker. EVMs aren't some niche thing. They already make up about 30% of all transactions in the U.S. That shows the demand is definitely there if the price feels right.
Hold on a second, though. That sounds great for us, the consumers, but you mentioned corporate support earlier. They expect to spend $75 million in Q4 just supporting these deals. Isn't McDonald's basically just using its own money to cover up a problem that the franchisees are facing right now? How do we know they won't need to keep paying that subsidy deep into 2026?
That's the million-dollar question, isn't it? Or maybe the $75 million question for Q4. Management tackled this directly on the call. They view this co-investment, where corporate covers half the cost of the discount right now, as a necessary upfront cost, a strategic investment. They're taking the margin hit now to fix a long-term perception problem and hopefully change customer habits. Their bet is that their scale, their huge size and strong balance sheet means they can withstand this value war longer than competitors. Drive volume, get people back in the door.
Okay, so it's a strategic gamble on volume. Now, besides the pure value EVMs, they also had some menu news, some innovation that seemed to hit well with customers maybe willing to spend a little more.
Absolutely.
Yeah.
The snack wraps, they came back early July, nationally advertised at $2.99. Management called them the most popular new chicken launch in recent U.S. history. Apparently, 1 out of every 5 customers bought one in those first 4 weeks.
Yeah.
So that shows there's still an appetite for new stuff, especially if it hits that sweet spot of value plus something new.
Right, and that plays into their big strategic focuses, chicken and beverages. They mentioned gaining share in chicken in their top 10 markets.
Yeah. And on beverages, that big test they're running over 500 restaurants in Colorado and Wisconsin seems to be going really well. Exceeding expectations, they said.
Yeah.
This seems to be where they're applying lessons from those separate cosmic drink places they tested, proving they can actually handle complex, higher-margin drinks within the regular McDonald's drive-thru. The test includes things like cold coffees, fruity drinks, fancy sodas, energy drinks, and apparently it's bringing in customers at different times of day. It's not just swapping out a Coke, it's driving new visits or getting people to add a drink, which helps the average check.
That makes sense. Okay, so the U.S. is this battleground focused on value and innovation to combat the consumer split. But as you said earlier, it's really the international side providing that cushion, right?
It's exactly where their global footprint pays off. International operated markets, the IOM group comps, were up 4.3%.
Wow.
And the international developmental license markets, IDL, up 4.7%. Both really strong. Germany was a standout strongest comp sales in 2 years.
Yeah, right.
Why?
Yeah.
They've focused on digital signups and menu items that actually appeal to local German tastes. Australia took a different tack, focusing on predictability. They locked in value prices for a whole year. Think about how reassuring that is for customers worried about inflation. And then you've got Japan. Japan is just executing incredibly well. 6 straight quarters gaining market share. Guest counts have been growing consistently for almost 2 years. It's this strength across the globe that gives McDonald's the financial room, the flexibility to pour money into the U.S. value fight without completely wrecking their overall profit outlook.
Okay, let's pivot to that outlook then, the guidance, because this is where that positive market reaction met some pretty cautious words from management. They were very clear. They see this consumer pressure sticking around, maybe well into 2026. And they stress they need to be 3 for 3, as they put it, meaning strong value, strong marketing, and strong menu news all at the same time to win. Now, let's go back to that crucial point about the EVM subsidy, the $75 million in Q4. How exactly does that support wind down? Because that seems key for investors.
Right, this is a strategic move that probably helps explain why the stock reacted positively despite the cautious tone. Management laid it out pretty clearly. Corporate support drops significantly in Q1 2026. At that point, they'll only cover 50% of the net negative cash flow impact for the franchisees. That's different from covering 50% of the entire discount. It's a much smaller amount. And then this is the big one. The corporate subsidy stops completely at the end of Q1 2026. Now, that's not just about saving corporate money. It's a calculated risk, like we talked about. Management is betting that by then, the EVM program will have driven enough extra sales volume, enough incrementality is the jargon, and changed enough customer habits that the franchisees will choose to keep the program going themselves. The logic is simple. Keeping the value deals will hopefully be better for the franchisees' own profits long-term due to higher traffic than going back to higher prices and lower volume.
And that focus on long-term cash flow, long-term health, is also underlined by their dividend policy, right? The board raised the quarterly dividend again by 5% to $1.86 a share. That marks 49 years in a row of dividend increases. That sends a pretty strong signal, doesn't it? Especially when they're also spending so much on value and tech right now.
It absolutely signals confidence. Confidence in their ability to generate cash over the long haul, even with these short-term costs. And thinking about immediate catalysts, digital is huge. That monopoly promotion they ran in October, apparently one of their biggest digital customer acquisition drives ever in the U.S., huge numbers of app downloads, registrations, just reinforces how central that digital platform is to delivering value and getting people engaged.
And looking just ahead to Q4, they do expect U.S. comp sales to pick up speed a bit, partly because the comparison to last year gets easier.
Yeah, basically Q4 last year had a slight dip because of a minor food safety issue that got some attention. So lapping that makes the year-over-year comparison easier, which should help the Q4 number look better. But they also warned again, expect above average inflation next year, especially for beef. So it's not going to be easy. They kept saying they just have to grind out growth in this tough environment.
Okay. This is the point where we try to bring all these pieces together into maybe a bold prediction. It's time for our segment. This is not financial advice. Remember, we're pitching an outrageous, maybe but plausible trade idea based only on what we heard in this call. Think of it as a thought experiment for an investment committee. Your pitch.
All right. The whole thesis hinges on that EVM transition we just discussed. We think the market is seriously underplaying McDonald's chances of successfully shifting that EVM strategy off corporate support and onto the franchisees by Q2 2026. And crucially, while McDonald's uses its global strength to absorb this temporary pain, a lot of their competitors simply don't have that financial firepower or geographic diversity. They can't afford a prolonged value war, especially against the McDonald's that's hitting the value message hard again.
Okay, makes sense. So what's the actual trade structure you're pitching?
The trade idea is go long MCD equity, but hedge it. Short a QSR competitor that's heavily reliant on that lower-income U.S. consumer and doesn't have much international business to offset the pressure. You know, think about a domestic-only burger chain that really can't afford to get dragged into a deep, sustained price war with McDonald's. And the reasoning behind it is pretty compelling, I think. McDonald's basically decided to take the hit in 2025, bundle the restructuring costs, the big EVM investment, into this year's earnings. They're solving a multi-year perception problem now. So when that corporate subsidy ends after Q1 2026, competitors who can't afford to keep matching those low prices are going to see their margins squeezed hard. Meanwhile, McDonald's could be enjoying higher volumes from the established EVMs, plus investors get reassured by that 49-year dividend history. It signals a cash flow strength others just don't have. It's really a bet on 2026 margin expansion, kind of hidden within a 2025 expense story.
That's a fascinating way to frame it, operational and financial strength winning out. Okay, so to wrap up our deep dive on this McDonald's call, the main takeaway seems clear. They are investing heavily. They're willing to accept some short-term margin pressure to push value in digital. That means the EVMs, the snack wraps, the Monopoly app push, the new drinks, all aimed at navigating this tricky consumer environment that they themselves see lasting well into 2026.
Exactly. They're sacrificing some profit now to secure leadership later. Which leads to a final thought, maybe something for you, the listener, to consider. How wide can this gap, this bifurcation between high and low income consumers in the U.S. actually get before the pressure we see concentrated there starts to spill over and impact even those strong international markets?
A powerful question about the global economy indeed. Well, thanks for joining us for this deep dive into the McDonald's Q3 transcript. And just a final reminder, this was all for informational purposes. Always do your own research before making any investment decisions. We'll catch you on the next call.